jump into high yield bonds.
High
First,
yield
start
bonds.
off with the basics, because I know a lot of shows like to talk big, and then you're like, if I only knew what that means, then I'd have a context of what the heck you're talking about. Let's just start with basics of what a high yield bond is and why somebody should care.
Okay. Also known as junk bonds.
We've all heard that before.
Yeah, see? So this is a higher yielding bond than what you would get from investment grade bonds, treasuries, or municipals. And the difference...
They're not the ones people are throwing away. That's not why they're calling them junk bonds. Okay.
No, you definitely want to hold on to them. A bond, just backtracking even a little bit further, is so I am giving money to a corporation. That corporation is going to sell me a bond, and they're going to pay me interest for borrowing my money over a designated time period, and at the end of that time period, they're going to give me my money back. So I give them $10,000. They're going to agree to pay me 6% a year, and then at the end of, let's call it 10 years, they give me my $10,000 back. That's pretty simple. So higher yielding or a high yield bond, because of the lower credit rating of that company, and in this case, it's the S&P ranks bonds and ratings of companies, and if they're below a triple B rating, they're considered high yield or junk bonds.
So higher risk.
Higher risk. So what you're getting with these lower credit ratings is a company like S&P, they're coming in and basically saying there's a higher chance of default by that company on this bond, and therefore, by you assuming that higher level of risk, that company is willing to pay you a higher interest rate for your investment.
Because they need your money.
They need your money.
Ultimately, a bond is a loan.
Right.
It's a loan to the corporation because they couldn't raise capital any other way. It's a capital raise.
Exactly.
Got it.
Exactly. And on average, typical is somewhere between 150 basis points to 300 basis points over what you would get from like an investment grade corporate bond. So in layman's terms, that's 1.5% to 3% above what you would receive from an investment grade corporate bond. So GE's bond may be paying you 3%. You'll probably get somewhere around 4.5% to 6% on a high yield bond.
Okay, so it could be really interesting. It could definitely. So do you believe that this belongs in people's portfolios so they could pick up a little extra yield here and there by taking a little extra risk?
Pretty much every single client I have, if they have a fixed income allocation or a bond allocation in their portfolio, have some form of high yield in there. So typically, if let's say a client has 40% of their portfolio that is in fixed income, we may have 5 to 10% of that potentially, depending on the client, that would be in high yield, and then the other 35 to 30% would be allocated into investment grade corporate bonds, short-term bonds, international bonds, different things like that.
Yeah, and let's be clear. I mean, it sounds bad when you call them junk bonds, but if it's something that you're willing to take a 4 or 5 or 6% return on, it probably isn't that risky. It's a big scheme of things.
It's still a bond, so it's not as risky. And the other thing is a lot of the way to invest, or the most common way to invest in the high yield market, is to purchase a high yield bond mutual fund or a high yield bond exchange traded fund. So now you're investing in this mutual fund, but this mutual fund owns 200 different high yield bonds.
So you're not going to, hey Guido, I want a high yield bond.
And taking a shot on that one company and putting all your eggs in that one basket. Right. So if you own 200 companies and a couple of them default, it's not going to kill the overall performance of the portfolio, and you're going to be able to benefit from the higher yields over